This is Pete Moore on Halo Talks NYC. I have the pleasure of bringing to our podcast Chris Van Dusen to start off 2025. We're going to talk about venture capital. We're going to talk about Solyco, and we're going to talk about the pros and cons of bringing somebody like him into your business to help you scale it. Chris, welcome to the show.
Thank you so much for having me. Appreciate it.
So we met through a very passionate networker and entrepreneur, C-Rock. So I want to give a shout out to him. And Chris, I want to take this episode and really try to hone in on for entrepreneurs, what is the benefit of going to somebody like you, taking capital from you, the way your fund is structured, to really match up the right opportunities with the right investors. So maybe you could give a little bit of your background coming from SoCal and, talk about the pros and cons of taking capital.
Sure. Yeah. So background, originally from the Northeast, came to California at the end of 2009. I wasn't always in venture. I did get a degree in economics from William & Mary in Virginia, but my career was anything but linear, right? Not the traditional route. Is in sales for many years. Had the opportunity to then go on the marketing side and started understanding how companies really scaled, how they worked. Started my own agency, and then had the opportunity to meet some great co-founders of ventures along the way, all kind of culminating in 3 exits, 2 in 21 that we sold and 1 in 2019. So I have, 3 exits under my belt, if you will. Many other gravestones along the way, as we know, because everyone likes talking about their successes. I'm happy to talk about the failures as well.
We talk about the real highlight reel, the real highlight reel.
The real, right? Yeah. Everyone shows you that home run swing. No one shows you the other strikeouts, right?
Sure.
So I had these 3 exits, and, during that journey, I met this gentleman, John Garcia, who founded Solyco Capital back in 2017. And loved their ethos, loved what they did. We talk a lot internally about the difference between capital and smart capital, right? Money and smart money. And I thought they were really a smart money type group. Again, loved their strategy. They invested in one of the deals that we took full cycle. So I joined them January of 22. And our firm is different. I was kind of alluding to that. The reason I say that is traditional venture. We're going to go raise a fund. We're going to have a mandate. We're going to have something we're interested in. That interest could be around AI. It could be industrial manufacturing, ESG, consumer goods, you name it. And then you go raise capital for that fund and then find assets to deploy. What we like doing is a little different. We're going to find great assets, great opportunities. We're going to set terms on deals. We're going to come in and help you. Then we're going to go to our LP base and we're going to go out generally to what we call our COIs or our network and go raise the capital for that specific venture. It allows us a little bit of flexibility in that we don't just take on specific deals. We may do biotech to FinTech to a straight play real estate project. We're finding great ways to inevitably make alpha for our investors.
So when you take a look at one of the benefits of a private equity fund that would have dedicated capital or venture is that they say, hey, look, I got a term sheet. I'm going to give it to you. If everything checks out, we could call the capital and fund this deal. Obviously, you've got guys that have had a lot of success, Garcia. So have there been instances where you have to pull back a term sheet, or when you guys have conviction on a deal and you want to put down a term sheet, look, we get this funded?
Yeah, we'll get this funded. To say it perfectly lays out to the timing that we had, I would think would be a little short-sighted, right? I would say from time to time we may delay, but we also bake that in. And so I want to make sure I'm clear here. We're not causing delays or hardship. What we're saying is, a traditional venture shop may deliver that term sheet and fund within a week. We're going to discuss, hey, we need 3 weeks or we need a month to fund, but here's how this is going to happen. Or here's how we're going to ladder in capital. That's really how we bridge this. Because you're right. It's the one thing we can't control in our model is time, right? Yeah. But again, allows us and our LPs flexibility.
Yeah, look, the private equity deal, the under-over on getting a deal funded from an LOI is like 6 months. So if you get deals closed in like a month, serendipity to everybody involved.
I would say it's those are going to be a little different. So maybe our full underwriting is the 6 months, right? But from term sheet to delivery. And the difference between the P kind of VC side, and not to be pedantic, is they're doing big minority or majority recaps or buying the company. So they're going, hey, we like what you have. Now we want to really get in that data room and make sure our
Yeah.
assumptions are correct. And that's your time. For us, we're going to do that before we ever deliver a term sheet in venture. So there may have been, and I would say the last probably 3-4 deals that I've brought in have been what I would call incubated, meaning I've known or met the founder. I've been looking and understanding the company. We've been in the data room, and this could be upwards of 4 or 5 months at this point before we're ready. Because the type of deals we like to be a part of are ones where they are capitalized, right? So think of seed round and above, seed A, B. They're capitalized, they're on their glide path, and maybe they're anticipating a raise in 6 months. So we're going to watch them hit their KPIs towards that raise. We're going to start discussing what a realistic valuation is going to be. We're going to start going into the data room. And that is that multi-month process. But the minute we deliver a term sheet, we were already at the point where we know we have conviction we're going to do it. And a lot of times we're already having conversations with those LPs on our side to say, we're getting close to funding something like this. Is this in, or we know it's in your wheelhouse, or is this in your wheelhouse, or do we want to do something here?
Yeah. I was doing a riff the other day on, seed round, Series A, Series B, Series D. And I was trying to remind the audience that the reason why you get a Series B is because the Series A went well, whatever experiment that was. Could you kind of, pour some either cold water, warm water, or, lukewarm water on the fact that, like, look, you don't automatically get to, swing at the bat every time. And your valuation, just because the valuation at the Series A was $6 million, you have to like prove that and then validate, at each step of the way. Maybe just like an education for entrepreneurs to kind of think like we do and understand like value is created or it's not created. And if you get another swing at the bat, I can't give you the same value for that swing.
Yeah. A great way to look at it is, and it almost goes up to a little bit of a more macro question, which is, when is it the right time to take capital from someone like me, right? Who does this for a living? And it's really saying, and it depends, but it's saying, I'm ready to grow to this next stage and I have market signals. I have new clients. I have manufacturing that needs to get done, whatever it may be, to get to that next level. So let's start. The reason why you received that valuation for your Series A is you were on glide path towards it. You just needed capital to really grow the team, grow your inventory, grow something, right? Now to qualify for your Series B, did I hit those goals? And then secondarily, am I on glide path for the next big growth or step function of my business? And if the answer is no, then you're not going to get this large new valuation. If the answer is maybe, but I need a little bit more time, maybe you do an extension round, what they call an A extension, right? Where it's maybe the same valuation because you really haven't hit it, but you're very close, or things are looking like they're going to be it. There's some macro factor that slowed it down. And so, but to your point, if we're underwriting the next round, we've set up modeling around it to say, here's what you should be at with the capital we have provided. And if you're there, great. If you're not, we're really going to want to understand why. And we're certainly not going to give you the valuation you'd want. And as a founder, every time you take capital from us, you're being diluted. And same with everyone else on the cap table or on the ledger of owners, if you will, right? And so I don't want to raise at that 6 million and then come back and need more capital at the same 6 million because that's just dilutive for, I don't want to say no reason, but that's extra dilutive to everyone involved. But if I go out and hit my goals, I'm going to bring in more capital at a higher valuation and it's going to be less dilution because I am on path to where I need to go.
One of the mistakes I made, which I am very vocal about my mistakes in life, and things that I don't want other people to have to experience. So at least I, tell a story and say, hey, do you want this to happen to you? I was kind of like trumpeting the fact that like I'm an angel investor. And then I realized that being an angel investor is a great way to kind of lose money because, like I'm supposed to kind of be an angel and like really nice to the entrepreneur all the time. And like, I'm just trying to be there to help. And then when I give advice and they don't take it, like somehow like this angel from like, what was that movie? Like Revenge of the Nerds or something, or like, something like that, like Chip Belushi. I think it was, like the angel's like, okay, no problem, no big deal, pat on the back, good try. And after that happens 4 or 5 times, you realize that like the angel is kind of like, could be like the angel of death because it's like, like how many times do you not listen to me? And I'm like still trying to be like helpful. So one, do you ever use that term? 2, why does that term exist? And like, when does the angel become like rational?
Yeah, right. So it's tough. Like let's go up one and say let's start at venture, and I'll answer the angel question, but let's start at venture. What we do. There's some facts out there, right? One is if you look at traditional venture, they're going to do a fund, as we were talking about, and those funds traditionally apply portfolio theory. Now, portfolio theory, very kind of 30,000 foot, is I'm going to make 10 investments, and let's assume they're the exact same. And I know that 4 of them, just like baseball we're talking about, I'm going to strike out 4 times. Yep. And then I'm going to have 1 home run. And that thing is going to return a really good, if not the entirety of what I've raised out of that fund. And then in the middle is going to be some singles, doubles, triples, hopefully, right? And that's going to get us our overall return. Typically, as an angel investor who's not doing early stage investing in a fund, but is actually angel investing in a deal, I have 1 deal. Meaning there's no portfolio theory. You have your 1 at bat. Right. And so that just by the law of statistics and probability says I have a much harder path to getting a return there. Now I can build my own portfolio by making 10, but now my cash outlay is much larger than it would have been on that one. Number 2, angel, if we think about it, the reason it's being used is it is extremely early stage. So traditionally, I call it friends and family and angel all being around this same thing. Mm-hmm. We invest in seed. Why that's important is traditionally these companies are in revenue, have market signals, and need capital to expand up before they do a large A round. If I go pre-seed or what we call angel, they may be in R&D. They may be just have their ideas or they're about to start a beta, but they're traditionally not in market, which means you believe in their idea. It's not in practice yet. So you're taking a higher risk overall. It's tough to be an angel in a Series B because this company is now doing revenue, might even, depending on the sector, be in EBITDA, meaning in profit. Are you much of an angel anymore? No, you're an investor at this point because you're investing in something. So it's, me and you saying we have an idea to revolutionize this space. We have put our capital in and gotten it to this place to show you there's something here. Now we want angel capital to come help us bring it to market. And then you come to someone like me to actually commercialize it from a growth perspective.
Okay, so I might be treating this almost like an entrepreneurial angel therapy session with Van Dusen, therapy. Some of the things that I've dealt with, just to get it out there, because your perspective on things that I've experienced is kind of like how I feel like this should play out now. Because I'm telling you what I did, and now people can say like, aha, maybe he shouldn't have done it that way, or you're giving a perspective. So let me ask you this other question. You've had LPs in deals that crush it, and those same LPs, are in your other deals. So that's fine. But then you've got LPs that are in like the 4 strikeouts, and they missed a home run, and they missed a single, and they missed a double, and they missed a triple. How do you kind of say like, look, we didn't do a fund. We came to you on each one. That's kind of like the pros and cons of, being able to pick your own vegetables.
Yeah. So I'll answer it 2 ways. One is, it's a delicate balance because every deal, if we put up 10 deals right now that we went and sourced together, Pete, right? We look at it and go, all these have amazing potential, maybe disproportionate. Maybe some are going to be the next huge, unicorn. And some you're like, no, this is going to be a great return. There are things like interest rate cycles we just went through and are still going through, global pandemics that happen, right? That end up derailing things that you can't foresee. Traditionally, the reason why you invest with an organization like ours or many others out there is there's a level of due diligence to say, do we believe in this? And do we have modeling and the right underwriting to say we believe it could happen versus an individual investor finding what we'll call a club deal, right? The country club deal, trying to figure out whether or not this is right? So there's a level of sophistication starts there. Number 2, our investors, especially, certainly on the equity side, are what are considered accredited investors or qualified investors. These are individuals who do not want to lose money, but also are making small bets. And anytime you're going to do, and I'm not a financial planner, so this is not financial advice, but when you are looking at, I have X amount per year or in my net worth to invest, right? There are certain ways to build portfolios. And traditionally, something like this is a very small part because it is going to naturally be more speculative than a mutual fund or a CD or an ETF you're going to buy. And so you're going to look at this as this small piece that if it goes away because of reasons within the growth trajectory doesn't happen, then this is my exposure. And that exposure is XYZ Capital. And so, but if it hits, that could be the biggest return in my portfolio for the year. And so there's just a little bit more of a speculation there. I would also say, and it's a weird way, and I don't take credit for this, I heard this from someone a few years ago, and it's such an interesting way of looking at it. Most professional investors, which I hate to call myself one, but this is what I do for a living, right? So by technicality, it's a professional. We are not as mad about the money we lose than the money we did not have the opportunity to earn. So let me break that down for 1 second. If we invest, let's just say $100,000 into a deal and it goes wrong, that is not good. We understand that. We've lost $100,000. If we pass on a deal and that 20X's, I didn't lose 100,000, right? I lost 22 million.
Yeah.
And so you've got to
that's tough love on yourself for sure.
Exactly. Right.
Real
But
tough.
That's where there's this balance of we want to participate in great opportunities and we want to be able to try to see into the future on what these things could be. But we're constantly having to evaluate and underwrite and do due diligence on, is this going to be something? How do we see it? And then with that capital outlay, do we believe we can be good fiduciaries to see it through from an investor side and investment side? Also, if we miss, what's the what would be that miss, right?
Yeah.
And no one bats 1,000. Never met that person in my life. So
we're not meeting him today, buddy.
Yeah. And so there's this level of, we're constantly trying to figure out those great deals, right? We'll use this, and it's a little kitschy, but we want to be truffle pigs. We want to find these amazing deals and bring them to our investors to participate in. But there's definitely a difference between the hard capital lost and the opportunity cost of not participating.
So there've been stories over the years where, like the guy from FedEx, he was kind of like on his last leg, and he got like a C plus or D plus or something on his business plan, and then had I don't know, I think he might have gone to Vegas or something, put his last 10 grand on to cover payroll, and then bam, it turned into what it did. One of the things that I've dealt with going along the lines of our this CVD therapy session here on the venture path is it's really hard to go to an entrepreneur who's they're working 18 hours a day, they're trying to make it work. You're look, it's the market's not resonating with your product. I put in here, capital I put in rocket fuel, and we're not going any faster, or we're going in reverse. And you got to shut those 4 out of 10 companies down, or you got to kind of let them die on their own, or they got to just turn into 3 or 4 people doing something that kind of keeps the lights on. One of the things that I ran into is hey, you're an angel investor, a big advocate of the business, and you're hey, look, you didn't make it work, and now I'm going to have to we're probably not friends anymore. It's not my fault, right? But I can't support you. And we were friends, but I was your investor. I wasn't your buddy. You're not my fraternity brother, and you're not, we're not related. So what are some of the things that you've had to deal with, maybe on a no names basis, or maybe an elegant way to kind of say look, I'm taking this exit ramp, and I'll give you back my equity. I don't think it's worth anything. I'll write it off as a tax write-off, but please don't call me to ask me for money, because I'm not your bank account, right?
Yeah. Personally, I haven't had that happen. So I want to be clear there. What I have had is you have certain investments, and we can see them. You can see these stories a lot when you look at the origin stories of some companies that may raise good money. They're on path, but you're right. There's something within the business that just can't be worked out.
Yeah.
Or you'll hear things in, let's call it FinTech or biotech, where there's some government change that comes through that affects all the way through your business, and you can't recoup costs, or the entirety of your model changed, right? And so when you're looking at that, that's what we call in the business a pivot, right? Is there a pivot place you can go? At its largest, and there are multiple, Silicon Valley dream companies today that started one direction, really couldn't execute, and then pivoted and went a different way, and now they're thriving. What is incumbent is having, especially when you're making an early stage investment at our level, right? Angel is going to be different because you can't command the same power traditionally, is to get a board seat. And that is traditionally a minimum that we look for, depending on if we're leading or board following into a round, is a board seat or board observer, because we want the ability to understand that level of detail in the business early on to help. Now, one thing about Solyco's model that's a little different is, we're a fairly large team and all. There's 11 of us senior partners. We have about 40 team members, including our leadership. And in a lot of cases, we go in these companies similar to what private equity would do, but early stage, and help them during this formidable time. So we can help them see over the horizon, not only capital needs, but certainly strategic needs. And if something doesn't resonate, start having those conversations now about where you can pivot to try to mitigate that issue, right? But you're not immune to it is the problem, and it happens. I would say if it's tough when you come in between someone and their money. Let's just start there, right? To go to the therapy session.
Sure.
And so there's a level of, if you're an investor and you're a minority investor, which angels are, especially early on, are you a passive investor who goes, here's some cash or here's some capital, let me know how it goes, I'm in your corner? Or are you, as part of your angel strategy, rolling up your sleeves and helping? Because that's traditionally what these founders want at that level of investment. Sure. And if you're not doing that, then my question is, why are you an angel investor in the first place? Traditionally, angel investors have something to give to that company to help other than capital, which means you're going to understand what's happening early on, and you'll be in the foxhole to your own level. And at the end, if it goes away, you're going to go, wow, we did everything we could. This just didn't work. And that puts you in a different understanding position around it. If you're just throwing capital and saying, why didn't it work? And you took my money. Well, I'd question whether or not you actually know what was going on and whether or not that founder was doing everything they possibly could. The answer could be yes. And then I'd say, okay, not why are you mad? You lost money. What could you have done? And on the other side, if you just throw money and the founder didn't do everything they're supposed to, my question is, how do you not know that being that early on?
So the last question here is, our main business is mergers and acquisitions. Out of that business, probably 80% is selling companies. This is usually selling companies that have EBITDA and have, either under a franchise or a franchisor. Quite frankly, I'd say probably 50% of the deals close, whether it's, valuation expectations are met. Something could happen negative in the business, like you're talking about, like a suntan tax that came on one of our companies, litigation on a wage and hour with in the state of California, where you have to pay overtime. Well, actually, you have to pay everyone hourly for like waiting for a massage or personal training, things like that are not, somewhat uncontrollable. In the deals that you work and the ecosystems that you work in, can you explain to the audience here, like how hard it is to actually sell a business and, actually get liquidity? Because I think sometimes people think like, oh, I can buy it. It's like oat milk, like that flies off the shelf, soy milk that flies off. It's like, no, dude, this is like cottage cheese with like a cover that really nobody knows what's in it. And I'm trying to sell something and I have to explain everything that's in it. And it's not that easy.
Yeah, I had the great fortune, so let me start there, of selling two companies in 1 year that I was involved in as an operator, meaning they were mine, right? I was one of the either co-founders or partner in, and was operating within the business. I will tell you, late nights, very early mornings, everyone's yelling at everyone. Now you think it should be a kumbaya, right? But it's not necessarily. You as a founder, entrepreneur with your co-founders or yourself, this is your baby. This is what you've spent years of your life, which means naturally you have a bias towards its value being high. As a buyer of a business, you have a bias that you know it's valuable. That's why you want to buy it. But you also want to buy it at the most fair price, which traditionally is not the same as the founder's value for their company. So there we start the negotiation. And the Buy side is looking for reasons to retrade the value down or question your assumptions. And as a founder, you're saying, no, I know my business is worth this because of all the amazing things, both hard things. And I use hard things like uh, contracts and IP and inventory versus soft costs. Like I've spent all this time and I know how it's valued to me and everyone who works here. And that starts being its own rub as well. There was an old joke an attorney told me a long time ago. If you're not dropping expletives and yelling at each other, are you even really negotiating for this deal? So the harder it becomes sometimes means you're actually driving towards progress. But I will tell you, all the sales I've been a part of, every day, just like the entrepreneurial journey, this is the best day of my life. We're going to get it. And this deal is already over. I just am realizing it now. And it keeps going like that for months, right? And then you get it done.
Yeah, I joke around that depending on how many deals we're working on at a time, it's kind of like playing a doubleheader in baseball. And you win one, you lose one. You try and like figure out like what really happened today. It's like progress at like 50, 1-1 or 2-2 or what have you. Yeah, man. So in closing here, we'll put all the information up and hopefully entrepreneurs find you or vice versa. Because I like your model and also seems like much more value add than a group that's coming in and just trying to portfolio theory on its own. I think that ethos and that starting point actually makes the psychology of you putting money into a deal different. So kudos for that. And if there's any advice or quotes or something else somebody told you that you want to share with us here on our audience for the health and fitness industry.
So sports tech in general, I love, and specifically around what you guys are focused on. With the advent of I don't say advent, that's not correct, but with AI being as pervasive as it is right now, there's a lot of amazing technology out there. We are invested in a company that's in AI for sports, specifically around scouting and player development. Oh, wow. And when you're looking at adding and appending that layer of data and then democratizing scouting globally, it's quite amazing what technology can do. Really, at the end of the day, I talk about it a lot, and it's something that I think everyone's ripped off of Warren Buffett over the years, but invest in what you know, right? I'm a former D1 athlete. I love sports. I understand what we're doing in AI, and that merged together works really well. So inadvertently, to me, I've become more of the sports guy within our firm, and I've originated a few deals in that space. And so very much enjoy that sector.
Great. Okay. Well, we'll hit you up on those. We got a pretty good flow, and whenever you don't want to use the word wellness, you can use the term halo. Yes, and appreciate you coming on here to kick off 2025.
Great. Thank you guys for having me. Really appreciate it.